Picture this. While most people are arguing about whether to buy individual stocks or crying about their latest crypto losses, a group of regular folks are quietly getting rich with something so boring that it barely makes headlines. These people aren't day trading. They're not following hot stock tips from social media. They're just putting their money into simple index funds and watching their accounts grow faster than almost everything else in the market. One woman in Ohio turned her $10,000 emergency fund into $47,000 in just 5 years using nothing but index funds. A teacher from Texas started with $200 a month and now has enough to retire early. And here's the crazy part. They're using the exact same funds that anyone can buy today. But here's what nobody talks about. Not all index funds are created equal, and 2025 has been absolutely wild for the ones that know how to pick their spots. Let's start with the absolute monsters of 2025. The VanEck Semiconductor ETF has been crushing it so hard that a $10,000 investment from 10 years ago would be worth over $85,000 today. But here's what's really insane. The gains in 2025 alone have been off the charts. Think about it. Every single thing around you right now, your phone, your laptop, your car, even your coffee maker, has semiconductors in it. And with AI exploding like it has, the demand for these chips isn't just growing, it's going absolutely bonkers. The iShares Semiconductor ETF is right behind it. And both of these funds are basically giving you a piece of every major chip company without having to pick winners and losers. You get NVIDIA, AMD, Intel, Taiwan Semiconductor, all the big players in one simple purchase. But semiconductors are just the beginning of this story, because there's another sector that's been even more shocking this year. Remember when everyone said oil was dead? When every investor was running away from energy stocks like they were radioactive? Well, 2025 has been the year of sweet, sweet revenge for energy index funds. Natural gas prices are having their highest year-on-year increase since 2016. And the funds that track this stuff are absolutely exploding. The United States 12-month natural gas fund has been one of the biggest surprises of the year. Here's what happened. Everyone got so focused on electric cars and renewable energy that they forgot something really important. We still need oil and gas for basically everything. Plastics, chemicals, heating, electricity generation when the wind isn't blowing. The list goes on forever. And while everyone was looking the other way, these energy companies got really good at making money. They cut costs, got more efficient, and started paying massive dividends. Now their index funds are paying investors while their stock prices go through the roof. But energy isn't the only sector making people rich in unexpected ways. Most people think index funds are just about growth. Buy low, sell high, hope for the best. But there's a whole world of index funds that are literally paying you to own them. And 2025 has been their year to shine. The SPDR S&P Dividend ETF tracks 135 stocks with the highest dividend yields in the S&P Composite 1500 index. But here's the magic part. These aren't just any dividend stocks. These are the dividend aristocrats. To become a dividend aristocrat, a company has to increase its dividend payment every single year for at least 25 years straight. Think about that. Through recessions, market crashes, global pandemics, wars, these companies kept paying their shareholders more money every single year. Companies like Coca-Cola, Johnson & Johnson, and McDonald's. They make money when times are good, and they still make money when times are terrible. And when you own the index fund, you own pieces of all of them. The best part? You're getting paid every quarter while you wait for the fund to grow. It's like having a job that pays you to sleep. But dividend funds are just one piece of a much bigger puzzle that's been dominating 2025. Here's something that might blow your mind. With all the fancy new investment strategies and crypto and AI stocks going crazy, the boring old S&P 500 is still crushing most active fund managers. Actively managed funds often underperform the market, while index funds match it. And as a result, passively managed index funds typically bring their investors better returns over the long term. Think about this for a second. Fund managers with Harvard MBAs, teams of analysts, and million-dollar computer systems are getting beaten by a simple fund that just buys the 500 biggest companies in America and holds on. The Vanguard S and P500 ETF, the SPDR S and P500 ETF, the iShares Core S and P500 ETF. They're all doing basically the same thing, and they're all making their investors rich while charging almost nothing in fees. But here's what's really crazy about 2025. It's not just the big companies that are winning. While everyone was watching the big tech companies, something interesting was happening with smaller companies. Small cap index funds started quietly outperforming almost everything else. Small cap companies are the little guys, companies worth between $300 million and $2 billion. They're not household names, but they're often growing faster than the giants because they have more room to expand. The Russell 2000 index tracks these smaller companies, and the funds that follow it have been absolutely crushing it in 2025. When small caps get hot, they really get hot, and this year has been their time to shine. Plus, when you own a small cap index fund, you're basically betting on the next generation of big companies. Today's small cap could be tomorrow's Apple or Amazon, but there's another type of fund that's been making waves for completely different reasons. Here's something most Americans don't think about. The US stock market is only about half of the world's total stock market value. That means if you only invest in American companies, you're missing out on half the opportunities in the world. International index funds let you own pieces of companies from all over the globe. European companies, Japanese companies, emerging market companies, all in one simple fund. And 2025 has been particularly good for international diversification. When American markets get nervous about trade wars and political drama, international markets often keep chugging along. The Vanguard Total International Stock ETF and the iShares MSCI EFI ETF have both been solid performers, giving investors exposure to thousands of companies they've never heard of, but that are making money hand over fist. But international investing isn't just about geography, it's about sectors that barely exist in America. Real estate investment trusts, or REITs, are basically companies that own real estate and pay out most of their profits as dividends. Think apartment buildings, shopping malls, office buildings, hospitals, cell phone towers, all kinds of real estate. REIT index funds let you become a real estate investor without having to deal with tenants, repairs, or property taxes. You just buy the fund and collect the rent checks. The Vanguard Real Estate ETF has been particularly strong in 2025, especially as interest rates started to stabilize and people realized that real estate isn't going anywhere. People still need places to live and work, and REIT funds let you profit from that basic human need. Plus, REITs are required by law to pay out at least 90% of their profits as dividends, so you're getting paid while you wait for the properties to appreciate in value. But be careful, as REITs might not be as simple as they seem, and are taxed as ordinary income at your full rate, so invest wisely and understand any personal tax implications. But real estate is just one alternative to traditional stocks and bonds. Most people think bonds are boring, old people investments, something your grandfather would buy and forget about. But 2025 has been a surprisingly good year for bond index funds, especially the ones that know how to play the interest rate game. When interest rates go up, bond prices usually go down. When interest rates go down, bond prices go up. It's like a financial seesaw. And smart bond fund managers have been riding this seesaw like professionals. The Vanguard Total Bond Market ETF and the iShares Core US Aggregate Bond ETF have both been delivering steady returns while providing that stability that every portfolio needs. Here's the thing about bonds. They're not trying to make you rich overnight. They're trying to make sure you don't go broke when everything else falls apart. And in a world where everything seems unstable, that's worth a lot more than people realize. But bonds aren't the only way to add stability to your portfolio. Target date funds are like having a professional investment manager who works for free. You pick the year you want to retire, and the fund automatically adjusts your investment mix as you get older. When you're young, it invests mostly in stocks because you have time to recover from market crashes. As you get closer to retirement, it gradually shifts more money into bonds and safer investments. The Vanguard Target Retirement 2060 Fund has been crushing it for younger investors, while the 2030 and 2040 funds have been solid for people closer to retirement. The beautiful thing about target date funds is that they take all the guesswork out of investing. You don't have to figure out how much to put in stocks versus bonds, domestic versus international. large cap versus small cap. The fund does all of that for you based on decades of research and data. But even target date funds can't solve every investment challenge. Environmental, social, and governance (ESG) funds invest in companies that are trying to make the world a better place while still making money. Think companies with good environmental practices, fair labor policies, and ethical business practices. For years, people thought you had to choose between making money and doing good. But 2025 has proven that wrong. ESG index funds have been competitive with traditional funds while giving investors the satisfaction of knowing their money is supporting companies they can feel good about. The Vanguard ESG-US Stock ETF and the iShares MSCI-KLD 400 Social ETF have both delivered solid returns while screening out companies involved in tobacco, weapons, and other controversial industries. Plus, there's growing evidence that companies with good ESG practices are actually better long-term investments because they're preparing for the future instead of just maximizing short-term profits. But ESG is just one way to invest with a purpose. Technology isn't just semiconductors, it's software, cloud computing, cybersecurity, artificial intelligence, and dozens of other subsectors that are all growing like crazy. The Technology Select Sector SPDR Fund has been one of the top performers in 2025, giving investors exposure to everything from Apple and Microsoft to smaller companies working on cutting-edge innovations. Here's what's really exciting about technology index funds. They're not just betting on one company or one trend, they're betting on human innovation itself. As long as people keep trying to solve problems with technology, these funds should keep making money. And the pace of innovation isn't slowing down. If anything, it's accelerating. Artificial intelligence, quantum computing, biotechnology, space exploration, we're living through one of the most innovative periods in human history. But technology isn't the only sector benefiting from major trends. Here's a demographic fact that's going to make healthcare investors rich. People are living longer, and there are more old people than ever before in human history. That means more demand for healthcare services, medical devices, and pharmaceuticals. The Healthcare Select Sector SPDR Fund has been taking advantage of this trend, investing in everything from pharmaceutical giants to medical device manufacturers to healthcare providers. And it's not just about old people. New medical technologies are making treatments possible that were science fiction just a few years ago. Gene therapy, personalized medicine, robotic surgery. The healthcare industry is innovating as fast as any technology company. Plus, healthcare is what economists call recession-resistant. People need medical care whether the economy is good or bad, which makes healthcare funds more stable than many other sector investments. But healthcare is just one of several defensive sectors that smart investors are watching. No matter what happens to the economy, people still need to eat, brush their teeth, and buy toilet paper. Consumer staples companies make the boring stuff that everyone needs, and their index funds have been surprisingly strong in 2025. The Consumer Staples Select Sector SPDR Fund invests in companies like Procter & Gamble, Coca-Cola, and Walmart. These aren't exciting growth stories, but they're consistent moneymakers that pay good dividends and rarely surprise investors in bad ways. During market volatility, consumer staples funds often hold up better than more exciting investments because their businesses are so predictable. People might stop buying new cars or taking vacations, but they don't stop buying groceries. And many of these companies have been around for decades or even centuries, proving that boring can be beautiful when it comes to making money. But sometimes the most exciting opportunities come from the most unexpected places. Emerging market index funds invest in companies from developing countries like China, India, Brazil, and South Korea. These markets are riskier than developed markets, but they also have more potential for explosive growth. The iShares MSCI Emerging Markets ETF has been volatile in 2025, but the long-term story is compelling. These countries have younger populations, growing middle classes, and economies that are expanding faster than developed countries. Plus, emerging market stocks are often cheaper than American stocks, which means more potential upside when things go right. The key is understanding that you're trading stability for growth potential. These funds aren't for everyone, But for investors who can handle the volatility, they offer exposure to some of the fastest growing economies in the world. And speaking of growth, there's one more category that's been making headlines. Instead of trying to pick which sectors or company sizes will do best, some investors just buy everything. Total stock market index funds own pieces of virtually every publicly traded company in America, from the biggest giants to the smallest startups. The Vanguard Total Stock Market ETF is the ultimate diversification play. You own Apple and Amazon, but you also own thousands of smaller companies that most people have never heard of. If any part of the American economy does well, you make money. This approach takes all the guesswork out of investing. You don't have to worry about whether technology stocks will beat healthcare stocks or whether small caps will outperform large caps. You just own everything and let the market sort it out. Several funds in the group track the S&P 500 and therefore provide access to large cap stocks representing about 80% of the US stock market. But total market funds go even further, giving you that last 20% of smaller companies too. Here's the thing about index funds that most people don't understand. They're not just investment products, they're wealth-building machines that work in the background while you live your life. You don't need to be a stock picker, you don't need to time the market, and you don't need to spend hours researching companies. The 17 types of funds we've talked about today, from semiconductor ETFs to dividend aristocrats to total market funds, they're all doing the same basic thing. They're taking your money and spreading it across hundreds or thousands of companies, letting you profit from the overall growth of the economy instead of betting on individual winners and losers. 2025 has shown us that this approach works. While crypto has been a roller coaster and active fund managers have struggled to beat the market, these index funds have quietly delivered consistent returns with minimal fees and maximum diversification. The best part? You can start with almost any amount of money. Whether you have $100 or $100,000, these funds are available to everyone. The woman from Ohio and the teacher from Texas didn't have any special knowledge or insider information. They just understood something that Wall Street doesn't want you to know. Sometimes the simplest approach is also the most effective. If this video helped you understand index funds better, take a look at some of our other videos that help to make personal finance simple.